Good morning and welcome to Coffee with Counterpoint. I'm Linda Eads and I'm the Funds Director at Counterpoint Asset Management. I'm here with my esteemed colleagues today. That is Paul Stewart, our CEO, as well as our three portfolio managers, or three of our portfolio managers, I should say. Our resident contrarian and value investor, Piet Viljoen, as well as Andrew Dowse, who manages some of our dividend equity funds and is involved in our multi-asset fund management, and Richard Henwood, who's involved with listed property management at Counterpoint Asset Management. But before we get on to today's discussions, I just wanted to remind you that if you are struggling to hear or your connectivity isn't great, that you should please close the other apps that you have open. GoToWebinar works best when it's the only thing that's on your laptop, open on your laptop. So do that. We're going to have a survey at the end. We're going to have several polls during the session. So please have your fingers on the buzzers to participate in our polls, and then we'll discuss the results thereafter. And we're going to have these sessions every third Wednesday. So if you want to diarize that, please do so and give us some feedback. There is a survey which will pop up at the end of the webinar, and we'd really love your comments on whether this works and whether this is something that you find of value and whether we should continue to do this and how we can improve it. So please do let us know and be as candid as you can be. And I'm going to start, as I say, with a business update. Paul has been very busy in the background merging three businesses. That's obviously Recium, Counterpoint Asset Management, and Bridge Fund Managers over the last year. And I would like to hand over to him to give us an update on how that's going. Over to you, Paul.
Thank you, Linda. Good morning, everybody. Thank you for your time spent with us this morning. I hope you enjoyed the session. I'm going to be very brief, but I thought it was important just to give all of our valued clients a brief update of where we are as far as the amalgamation of the business is concerned. It's been an incredibly busy start to 2021. It's hard to believe that we're approaching the second half of February, but fortunately, the year has started very positively. We've had some nice investment performance in some of our key investment strategies, notably the value fund, strong recovery in the pays and risk portfolios in the last quarter of last year, which has fed through to the first 2 months of 2021, and a strong turnaround in the performance of the global portfolios. Obviously, investment performance always helps in respect to the amalgamation of teams and people business. So very gratified with that. Obviously, 2021 for myself as the CEO is really all about affirming structure and stability within the business. When you're bringing 3 different entities into a single operating unit, requires an enormous amount of energy and getting down systems and people and processes and those types of things. So, me, it's about stabilizing the shareholding structure of the business, which we have now done. It's about making sure structurally that the business is sound. And I know that if you look at the pictures this morning, we are all in the office in Claremont. We've actually separated people from in different venues today just to ensure that the technology doesn't fail us and make sure that the webinar is practical. But we are all in office in Cape Town. And that's very important. And then it's about making sure that we've got the right people in the right places doing the right things. So once again, we're working very hard on making sure that people are aligned in appropriate roles. And the inevitable change that occurs around people, we still got a couple of changes to make in the business. We've made almost all of the changes that I've wanted to make already. We make a couple of additional announcements in the next few days and weeks. I'm very, very satisfied with the quality of our investment team, and particularly our younger members of the investment team. Myself and Piet, we've got a bit of grey hair, and Ian Anderson, but we've a very talented crop of young managers, and I believe that we have got some stars, some rising stars in our ranks, and look forward to hearing from 2 of them in today's session. The other 2 things we will focus on during the year of 2021 is affirming the Counterpoint brand. And in this regard, we will obviously be doing regular communication with our clients as the year unfolds. So thank you very much for your ongoing support of the business. We do appreciate it. I would now like to hand back to Linda to actually take through the important part of this session today around the Q&A. So thank you, Linda.
Thank you, Paul. So you will see that there is a little section on your drop-down menu that says questions. So if you have any questions for our panel, do pop them in there, and we'll try to get them to the panel and have them answered for you. We're going to do a sort of a discussion about what's moving the markets, but we also want to talk about what we're doing about that, how we're invested as a result of the opportunities that we see. And this session is not really a specific fund update. We do fund-specific webinars. It's really just a glimpse into the sort of types of conversations that we might be having around the table as part of the investment team. So we're going to talk about some of the topical issues that we are discussing amongst ourselves. And that sort of to kick that off, I think that the sort of three words, or two words rather, that have been sort of doing the rounds in the media of late is the commodity super cycle. You know, we see energy stocks have been leading the pack. The energy sector is up 50% since the start of November. But interestingly, if you actually take a step back, the sector's only delivered 9% since 2007, and it's actually still down 44% from 2014 levels. So it depends on what sort of time frame you're looking at, but certainly we've seen a massive rebound in the short term. Piet, you recently put up a chart which actually shows the inverse correlation between commodities, and I think it was the S&P 500 that was used as a proxy for equity markets. It looks like, you know, judging on that chart, which is 10-year cycles, it looks like we might be at the beginning of an upcycle for commodities. Do you think we're entering a commodity super cycle, Piet?
Well, I'd be loath to use the term commodity super cycle. I think that's sort of term used by stockbrokers to sell stock at the top of the cycle when you're looking backwards. But I do think we are unequivocally in a commodity bull market. There's no doubt in my mind that we are in a commodity bull market, and we are at the beginning stage of a commodity bull market. Whether this thing will still morph into a super cycle, I don't know. But this commodity upcycle started in the beginning of 2020. It was interrupted by the COVID pandemic and the government's response to that, but it has picked up steam again, and I think we are at the start of a cycle where commodities and commodity-related assets will do at least relatively well for the foreseeable future. And when I say foreseeable future, I mean on the 3 to 5 year view, not on the 6 months view.
Andrew, you are focused on yielding stocks. Resources don't fit neatly into that bucket. How do you view that from the perspective of a portfolio manager managing a fund that focuses on yield and capital growth?
Yeah, well, I mean, look, I think the evidence, as Piet communicated, is pointing towards a possibility of, you know, a rise in commodities that could be sustained for some time. You know, we had results come out from Glencore and BHP yesterday, and they were fairly encouraging, actually. Glencore even felt confident enough to reinstate their dividend. You know, so I think the mining companies are giving signals. I mean, there are other signals in the market, and you can just hear it from the sort of rhetoric and communication that's happening. I was listening to Michael Avery's show on Fine Music Radio yesterday, and you know, there was this whole conversation about the commodity super cycle, and we're just entering into it. And what are governments doing to allow regulation for more exploration of minerals, etc.? And I think, yeah, so there is the possibility, but I do think that we're still quite early in the cycle. And so to, you know, get too excited, only to find that maybe, you know, commodity demand drops off, and there is no super cycle that sort of plays out from that, you need to be cautious. Yeah, so from a sort of yielding perspective in our portfolios, I mean, we're looking at particularly the diversified miners at the moment with regard to this, and you know, they are starting to generate large amounts of free cash in their business. They've worked hard over the last 5 to 10 years in really bedding down their debt levels, so that they're not so overgeared and at risk, basically, of going bankrupt. They've also worked hard on controlling supply, so they haven't come to the market yet, although the communication seems to be increasing about ideas of expanding supply in certain commodities. But at the moment, no miners are really committing large amounts of capital to open mines. In fact, Glencore is sort of shutting some mines that are marginally profitable or just untenuous to mine, with government regulations in some countries. So It's an interesting space at the moment. And if it turns into a commodity super cycle, these miners certainly will be generating large free cash flows and return substantial dividends to shareholders. And that's something that we, from a payers and growers perspective or income yielding perspective, certainly continue to keep our eye on. And, you know, we don't ordinarily venture into commodity companies because they tend to be highly cyclical and you can't predict when the commodities fall. But at the same time, you know, we're cautious to forego the opportunity that can be given from this cycle.
Yeah, I think yesterday both BHP and Glencore reported results, and both of them surprised me upside with their dividend payouts, which I think is, points to where we're going here.
And obviously, I mean, if you think about strong commodity prices, I mean, that usually comes hand in hand with a weaker dollar. And so I wanted to just actually unpack a little bit what a weaker dollar, I mean, we obviously always talk about a weak dollar, don't we, rather than a strong rand. But it is fair to say that a weak dollar does mean stronger emerging market currencies across the board and stronger other currencies depending on trade, etc. Andrew, I want to stick with you. I mean, in terms of a weaker dollar, I mean, who are the winners and losers with that as a backdrop, if that happens to be the case? Let's say commodities are about to start a dramatic upswing.
Yeah, so, I mean, thinking about that, you know, certainly I think it would be good for emerging markets. A weaker dollar typically, you know, supports lower inflation for emerging markets. It also helps them with their budget deficits. And trade deficits certainly turn to trade surpluses, as we're observing in South Africa. That creates, you know, for emerging markets that are involved in mining, creates a nice windfall in terms of taxes, and it allows the governments to direct some additional spending towards infrastructure type projects, as well as where emerging markets often are net importers of, you know, more manufactured goods and beneficiated goods, as opposed to exporting the primary raw materials. You know, it supports lower inflation on those imported goods that they're bringing into the market. So basically, you know, there's a windfall for emerging markets, I think, generally. You know, in terms of stocks, or let's talk industries and sectors, maybe, I think it will be good for miners and oil in particular. Obviously, a weaker dollar tends to drive up the demand for commodities, and so that demand ends up in higher prices and miners tend to make more money. Similarly, oil also tends to rise because, you know, again, people will be happy to utilize more oil in all forms of production or energy generation. And, you know, it's denominated in US dollars, so if the dollar weakens, typically the value of the good must still stay the same in all other markets, which means the price in dollars rises. I think it's good for gold spot. However, I would be cautious to draw the same conclusions necessary through to the gold miners, in my view, personally. I think, you know, if the gold miners are operating in these emerging market countries where possibly labor costs might be rising and they're facing a currency headwind, I would prefer, if you're going to go for gold, I would own the gold spot or the commodity itself rather than the miners. But don't be caught out, because the gold miners also could become highly profitable if demand surges sufficiently and volumes increase. Well, they are already. You know, so the question is how much more profitable, given the price that you're paying for them, might it become?
So if I sort of extrapolate, you know, what you're saying, which is basically, you know, that it's going to be good for emerging markets, that, you know, a weaker dollar obviously means a stronger rand, then I'd like to sort of bring it more sort of closer to home. But before we do that, I want to just launch a quick poll. So I'd like everybody to say, basically this poll, let me see if I can launch it here. You should be seeing it on your screen. Basically, out of 46 country ETFs, which obviously track sort of country indices, such as sort of MSCI indices, how did SA rank in terms of year-to-date returns in US dollars? So I wonder if you guys could just fill in that poll, let us know what you think. How do you think it performed. Guys, what do you think? Piet, I'll start with you, oldest to youngest. Piet?
Well, we start with me then. No, top quartile.
Top quartile, okay. I actually don't know who's older out of Andrew and Richard. Okay, let's go Andrew. Okay.
Yeah, I mean, I agree. I think I agree. I think it also a top quartile just from the makeup of our market.
Okay, right. Well, let me give you the results for that. Okay, 46 people said that it was in the top quartile, 31% said second quartile, 20% said third quartile, and 3% said fourth quartile. So now what I'm going to do is I'm actually going to share the results with you. Let me just, let's see if I can get this on the screen. Right, so here's the slide. You should be seeing a slide which basically has the title Year-to-Date USD Performance per Country ETF. Remembering that there are 46 countries, this little list. I think I'm waiting for the screen there. It's taking a little bit of time to come up there. I think it might be the connectivity. Okay, well, I'll just give you the results because I happen to have them handy. So South Africa came second out of 46 countries in terms of year-to-date US dollar returns. And the interesting thing about this is that, funnily enough, my husband actually sent this to me, saw it on Twitter, and he said, well, I suppose that's, you know, sort of mostly the Rand. And I actually looked at the Rand's performance, and it's only 1.5% of that return, because if you think about where the Rand was at year end, it was actually sort of in similar levels to where it is today. So it's strengthened about 1.5%. It's been very volatile, but it's actually not really the Rand, which is quite interesting. And I see that the US is, for instance, 5% in US dollar terms, and countries like Brazil are minus 2.8% over the year to date. So this speaks to, you know, sort of a resurgence of South Africa, it's certainly in terms of returns. And, you know, we have seen a bit of a comeback there. I want to turn to you, Richard, because you're focused on certainly listed property in South Africa, and talk about, you know, we've seen a rally. Certainly it's down still significantly over the last sort of year and going further back than that. Is there more to come, or is this sort of pricing in best case scenario in terms of a rollout of their vaccine and the likes?
Yeah, I mean, we've obviously experienced quite a bounce in SA listed property as well as global from November. Obviously, the announcements of the vaccines that were approved by the regulators and many of the developed market governments obviously rolling out their programs to get these vaccines to their citizens, obviously turned many of the COVID losers during 2020 into sort of more now your short-term winners as sentiment towards them changed. SA listed property was probably one of the worst performing property sectors from a geographical point, just because of its very overweight exposure or significant exposure to your traditional office and larger retail formats. So the bounce, when it was going to come, South Africa's REIT market was probably going to bounce hardest, just given the nature again of that sort of sector. And that's what we've sort of seen. Obviously, November, December's returns were sort of double digit. We did see a bit of a pullback in January. There was one or two company specific announcements that probably led to that. But now again in February, we've seen another 9% month to date move in the SAPI index as these sort of, you know, these traditional office retail landlords have obviously come back into favor, with a lot of guys looking to try to buy at the bottom and get back in. You know, where we are now with regards to valuations, look, there's no doubt, I think there's a lot more talk in the market about a third wave coming, specifically for South Africa, probably in our winter season, June, July. So I don't think we're out of the woods yet. Obviously, our vaccine rollout program has been delayed for various reasons. Probably should have expected that, being more sort of based here in South Africa and knowing our government and their record of delivery. So yeah, I don't think we're out of the woods yet. But you know, current valuations on a medium to long term, I think there's tremendous upside. But maybe in the short term, we might see our local investors becoming a little bit more bearish as we maybe go through that third wave. It's maybe a bit worse than expected. And obviously, maybe if there's even further delays to a vaccine rollout in South Africa, it might create a more of a negative view in the short term. But on the flip side, we definitely think, well, I personally think there is still a high likelihood of at least a little bit of M&A in the sector, which might unlock some of these dramatic sort of discounts to NAV that we see, as well as a lot of these management teams are focusing on deleveraging. Obviously, their balance sheets and liquidity are under pressure. They've got the means to potentially do some deals. Yesterday, Resilient actually put out quite an interesting announcement into the market. They've sort of got they're in exclusive discussions with the PRC, obviously a large buyer of property, both listed and direct. And then exclusive talks to maybe offload about 7 malls to them. It's 5.5 billion rands worth of property. And historically, PRC have always been a good buyer of property. They haven't been too demanding on discounted prices. They pay fair prices. So if we do see some big deals or transactions like this at sort of book values, it might be a catalyst to some short-term price appreciation. But I mean, that's lots of ifs. They've just started those exclusive discussions. Let's see where we go.
Piet, I'd like you to come in here. Obviously, looking at South Africa, I mean, your fund, the Value Fund, is completely focused on South Africa by choice. It's allowed to invest offshore, but you have 100% of your fund in South Africa. Maybe you could talk to some of the opportunities that you're seeing on the value side of the equation.
Well, property is not one of them at this point. We don't think property is a value situation. We think there's a structural problem in the form of the way these companies are structured in REITs. I don't think REITs allow for a company to retain enough capital to maintain its properties, let alone to grow. These companies are grown by using debt. They become over-indebted, and now they have to sell assets at a very poor point in the cycle. And even though they're getting book value isn't really very high at this point in time. So I think due to poor capital management, these companies have found themselves in a hole, and I think this hole is still very deep. So the Value Fund doesn't own any property at this point in time. Sorry, any of the REITs. We own no REITs. We do own property in the form of Viljoen, which is a property developer, a residential property developer in the low to middle income market, 500,000 Rand units to 2 million Rand units. That market is growing, according to Uber, the mortgage unit, by 34% year on year in the fourth quarter of 2020. So that's a growth market, and you can buy Viljoen shares at below net asset value, way below, like a 30% discount to net asset value. That for me is a value situation, and it's a company that hasn't needed to go to shareholders to recapitalize. It's got enough capital on its balance sheet, and it's doing very well at this point in time. So that's the sort of situation which I find attractive. Very depressed price for a business which is operating in a market that is growing, where there's demand for the product. And I think in South Africa broadly, there are many opportunities like that to acquire assets at multiples of valuations which are cheap in absolute terms, and relative to the rest of the world is dirt cheap. So the same business that is operating in South Africa, if it was just listed in a different jurisdiction, say America or Europe, we traded multiples of where it is trading now. And we've seen concrete examples of that in the likes of Montauk and also in Cartrack, where they just shifted the listing to the NASDAQ, and all of a sudden the Cartrack share price goes from 25 Rand to, I don't know, 80 Rand at one point. Montauk goes from 40 Rand to 200 Rand, and nothing's changed. Same business, same people running it, just a different jurisdiction, listing jurisdiction, introducing it to a new class of buyers who value these companies based on fundamentals and not because it's listed in South Africa and I don't want anything to do with assets in South Africa, sort of mindset. So I think there are many opportunities still in South Africa remaining. I think the market overall is cheap, and within the market there are very cheap assets. So it really is the sweet spot right now to be a value investor in South Africa.
And Andrew, can I ask you to come in there, because obviously your funds are also very South Africa focused in terms of looking for capital growth and yield in terms of your total return. And what are sort of the opportunities that you're finding sort of the juiciest in the current landscape?
Yeah, I think there are some somewhat unloved businesses. Whether it be more recently maybe the hospital groups. We own Netcare, and Netcare, ordinarily you would have, and we spoke about this in fact last month, you would have expected that people would be going to hospitals more in need of healthcare, around COVID. the reality was the first wave, occupancies were substantially lower. In the second wave, we saw better occupancy and utilization, particularly from sharing of patients, sharing the load between public and private. And so Netcare, expectedly, or at least as an analyst, we expected a rebound in these occupancy levels, even just because, elective procedures just couldn't be deferred forever. And so, they put out a trading update quite recently, and actually it was very encouraging. I sometimes say to some of the guys in the team, I don't know why I get surprised at my own expectation. Like I expected it to be better, and then when it delivered and the share price reacted positively, why am I so surprised? That was my view. So yeah, I think there are kind of opportunities in the SA market where when you start looking outside of the SA market, and particularly in developed markets, you start to find businesses that have been propped up with excessively cheap capital. So interest rates being suppressed to zero, particularly in the US, has resulted in investors looking for any asset class that can deliver some form of yield, if you're a yield investor, or anything that has any element of growth either. And so you're looking at relatively very expensive markets when you look, markets like the US, and in some places in continental Europe, even when you compare it to markets like South Africa, where we're on depressed multiples, PE multiples, also on depressed earnings basis. So you've actually got, a double whammy. When earnings recovery happens, that multiple can also expand, and it's really just a function of excessively cheap cost of money that has allowed this to happen in developed markets. So, there's a combination of, do you want to put all your eggs into one basket where it might be expensive? A lot of people in South Africa, I think, have taken that view recently, to take their money offshore at any cost, because we do tend to be a bit volatile, particularly with the rand, and we have little faith in our government. But I'm not sure that the rest of the world and the world of investors necessarily share a negative view about South Africa always. When they see the right opportunity, they will come back, and we've seen some flow back into the SA markets that's been encouraging more recently. So we certainly are hopeful for a value unlock in our market. Yeah.
Well, we're going to actually sort of change gears. I see Bruce Anderson has said, when will the crypto mania end? And 4,000 coins is the world's largest, most sophisticated Ponzi scheme. But before that, I think we do have some different views amongst the team, so I want to explore that. But I want to launch another poll. So what I'm going to ask everyone is, what would you prefer to have 10% of in your fund, Bitcoin or gold? Now, we can't invest in Bitcoin, but I know, Piet, you do have gold in your fund. But let's just see what the response is. I'm going to give it a few seconds just to collate the responses there. Some interesting facts that I learned about Bitcoin is that from an ESG perspective, which is quite contradictory with Tesla obviously sort of buying $1.5 billion worth of it, is that apparently it has the carbon footprint of the whole of New Zealand, uses the same energy as the whole of Chile, and that one Bitcoin transaction is equivalent to something like 450,000 Visa transactions. So I think there's been quite a lot of pushback on sort of Tesla being the sort of green energy vehicle that it's supposed to be, buying Bitcoin, which I found quite interesting. Okay, right, so I'm going to close the poll and I'm going to share the results that I've figured out how to do that. And you can see that 80% of the people who voted in the poll chose gold and 20% Bitcoin. I also read somewhere that obviously that's the most likely person to buy Bitcoin is a male under the age of 30. We don't have any of those on the panel, so unfortunately I can't ask. But Piet, can you perhaps give us your view on Bitcoin? I know you have some interesting views to share on this.
I wish I was under 30, but I do own some Bitcoin. No, maybe that's the exception that proves the rule. But I do think there is a strong case to be made out to own a very small portion of your investment, not 10%, definitely not 10%, but a small portion of your asset value or net asset value or wealth, whatever you want to call it, in something like Bitcoin. There is the potential for Bitcoin to go up by multiples of where it is now. It has already gone up by a lot, but it still has the potential to go up by multiples. The odds of that happening, I rate is quite low. It's possible, but probably not likely. It's probably the odds of that it goes to zero is probably higher than it goes up by a factor of 20. So it's quite conceivable it could go to zero, but it could go up by a factor of 20 or 30 or 50. And if you just say that currently in the world there are 13 to 15 trillion dollars worth of negative yielding bonds, if the holders of those, say $15 trillion of bonds, wake up one day and say, hang on, but we don't want to pay governments to invest our money with them. We'd rather put in something where at least, we don't pay anybody anything. If that had to move to Bitcoin, it would go by a factor of 15 to 20 times from where we are today. So that's unlikely, but possible. It's also possible that it goes to zero. So I would say allocate a very small portion of your wealth to something like Bitcoin, and then forget about it and see what happens. I don't think it should make up a major part of anybody's portfolio. I think that would be irrational. It's still very young. It's lightly regulated. It's still finding its way through the regulatory environment to the extent where you're not allowed to buy it for funds. I've been trying now for 5 years to buy it for the value fund. I've not been able to get any form of Bitcoin related asset into the value fund now for 5 years. I have been able to get into the worldwide flexible fund, but it's hard. It's not easy. So the regular environment is opaque at this point in time. There are lots of risks still associated with it, lots of dodgy characters. So, but I think you can make out a strong case for a de minimis investment in Bitcoin in your portfolio.
Andrew, Richard, anything to add to that? Do you agree? Do you hold Bitcoin? Do either of you hold Bitcoin in your own personal capacity?
I wish I did now, but no, I don't. I very much agree with the poll. Probably also confirms my age is above 30. Definitely wouldn't be holding too much Bitcoin at the moment, given the current valuations of gold versus Bitcoin. Probably have a higher weighting to gold. I definitely think there will be a pullback at some point, like Piet described. I think this thing is fairly young. There's still regulators are going to get hold of it. There's also going to be lots of alternatives that come along the way. Facebook are still pushing for their own sort of cryptos, Libra and stuff. There'll be many other guys that come along with their sort of alternative cryptocurrency. So I think at some point there'll be an opportunity to buy. You'll see which ones may be more in favor, which ones the regulators are more happy to allow to get into funds, to be used by institutional investors. I just don't think buying Bitcoin now is a good sort of short to medium term trade. I think the price is pretty full.
Yes, when it gets to 50,000, actually touched over $50,000 yesterday. I'm sure everybody already knows that. But my husband seems to be particularly bullish when it's up. But then when it fell back to $30,000, he said, no, this thing's going to zero. So I said, but now's the time to buy. That's always the problem, isn't it? Everybody wants to get in after the event. But yes, I think it probably will disrupt sort of the traditional banking system over time. The question is how to take advantage of that now without sort of putting any portfolio at risk. But moving on to other things moving the market, to sort of on a similar vein, we'd be remiss if we didn't talk about sort of the GameStop saga that we saw. And I think I wanted to raise the issue. We're obviously active managers, and thus we believe that there is mispricing in the market that we can take advantage of. In other words, the markets are not efficient. Andrew, I want to put this to you. Do you think that the democratization, as they call it, of the trade of markets, more participants coming in, having it be more accessible, do you think that makes markets more or less efficient over time?
Yeah, it's an interesting debate. I must admit, maybe I'm a little bit cynical in my view here, but personally, I think, what happened with GameStop and some of the other similar companies, BlackBerry, AMC Entertainment, and Cost were a couple of the other names that were sort of painted with the same brush. There were large hedge funds that were taking a one-sided bet that these companies were going out of business, and there was good reason for those bets to be taken. I mean, there were businesses operating in industries that are facing severe headwinds. As an example, Cost makes stereo headphones. GameStop makes like video games in a store. They're a retail store of video games. Video games are now bought through the internet. You know, you don't get a CD anymore and install this thing. So what do you need the store for? So, I mean, there were good reasons to take negative bets on these companies. Unfortunately, what happened was there was basically a group of investors that identified, you know, that there was a substantial, large, one-sided bet, and all that they needed to do was convince enough people through a platform like Reddit to follow their view in taking the alternate bet, and they could get these guys to hurt real bad, which they did. The guys that obviously were short were largely institutional market investors, and the Reddit following was, you know, a bunch of retail investors through platforms like Robinhood. And if you expose a sort of a constraint in the market, it can be a very sharp reaction that happens as a result of it. So look, I mean, I think my view is, what was the actual fundamental driver for the reason for this to happen? And I think it was a few select investors that identified an opportunity for their own selfish interests. And so to try and draw the conclusion that getting more retail investors to participate in markets like this, well, I don't think they were participating for fundamental reasons. They were following a trend or a narrative that was pushed upon them. And so I think one needs to be cautious that this will, in the future, result in inefficient markets. In fact, my view is that it makes it actually less efficient because people are not making fundamental or rational decisions. They are just following a trend or a narrative. And at some point, the narrative will be against the direction of where retail investors are. So yeah, be cautious.
So I'm going to move
in the market. That's a new one.
What's that, Chris?
Since when have people been rational in markets? Markets have always been.
But I think yeah, thank heavens, otherwise we wouldn't have a job if there weren't irrational market participants. But I suppose the time frame, you know, we always talk about the fact that most market participants, even professional investors, don't have a time frame which actually allows you to capitalize on the long-term underlying value of businesses. So that alone, in terms of sort of taking short-term views, does cause mispricing to occur. And that is, I think, we would say, happening in the local property market, Richard. We've got some questions asking about yields in property funds. And I think we also need to speak about the yields and dividends on sort of a wider sort of basis as well, Andrew. There have been a few questions. One, I suppose, if you take the view that markets are inefficient and that bad news causes opportunities to arise, you want to be buying dividend-paying stocks when the dividends are under pressure. Is that right?
Yes, I think broadly that's true. So Richard, do you want to take that on a property perspective first, and then I'll jump in after you?
Sure, yeah. I mean, obviously from the South African listed property as well as global, I mean, last year was an absolute disaster for income investors that were obviously in the asset class for an income return. Obviously, the lockdowns caused a lot of grief for landlords. They had to give a lot of COVID rental relief, and obviously that dropped their distributable earnings. It created more pressure from a liquidity point of view for their balance sheets. And obviously it caused them to also look to retain as much cash as possible, given the uncertain time, given the uncertainty around how long it might last, how long they might have to give this relief to their tenants. They all realized quite quickly that they needed to give the relief to get these tenants through this. They didn't want their tenants to obviously go out of business and then be left with no tenants post the COVID. And so obviously payout ratios were sort of dropped sort of around from 100% down to 75%, 80% on average. So, you know, it was a disaster for income investors, almost like a bit of a grey swan event, unfortunately. Although we do see a little bit of a bounce back coming in 2021, obviously not as much COVID rental relief given. There is still some in the system. There's still some tenants that aren't operating at full level or at the pre-COVID levels. Think of the hospitality sector, the food and beverage, the entertainment sector, movies, etc., etc. But we do also see maybe the payout ratios sort of returning maybe towards the 80 to 90%. But unfortunately, I think it's still some way away from, or a couple of years away from us seeing sort of pre-COVID income levels produced by the SA REIT sector. I think obviously, there's going to be sort of a long sort of recovery coming out of the market. And I think the payout ratios was a discussion point for many years going into COVID. 100% was never going to be sustainable. Obviously, Piet alluded to the business model not necessarily being a sustainable business model. A lower payout ratio does make the model a lot more sustainable. And so we do see them sort of moving towards the 80 to probably 85% payout ratio going forward. So it just does mean we're now off a lower base. We will grow off the lower base, but it will take some time for those income levels to return to sort of pre-COVID levels. But there's definitely, the prices have dropped more than the income levels. There's obviously great opportunities for yield, for new investors to come in, or for investors to add to their sort of listed property asset classes, especially when you look at how low the yields are in money market funds and any alternatives. Yeah.
Andrew, would you care to comment on sort of how this plays out with regards to the sort of wider landscape there?
Yes. So, I mean, something that we have observed that affected dividend payouts, particularly in equity markets, was businesses that use debt typically have covenants related to those debts or collateral that they have to put up against the debt. And they need to maintain certain levels of profitability to make sure that the lenders remain comfortable that they will be able to service the debt. And they don't want to see businesses then paying dividends if the lenders are concerned that your ability to service the debt may become impaired. So the measure in South Africa probably mostly utilized is net debt to EBITDA. Now, what happened through COVID and the crash, some businesses were severely affected where their operations had to cease for the better part of 6 months. And even when they did return, they were sort of returning on very slow recovery. And so they weren't necessarily covering all of their costs. I think the SA businesses did an exceptional job to manage costs through this period, but nevertheless, their costs, they were probably marginally loss-making or at best break even. And that means that when you measure net debt to EBITDA, EBITDA is typically like your operational profitability measure. And if you are just breaking even on an operational basis, then your EBITDA number is basically zero. And so your net debt to EBITDA kind of looks like it's starting to go asymptotic or whatever you call it, that it goes to infinity. So at that point, that's where the lenders tend to get cautious and invoke their rights to prohibit you from paying dividends. That's a temporary scenario that the market goes through. These businesses we've seen the government is far more apprehensive about going to severe lockdowns. They have realized the effect it has on the economy, and these businesses are getting back to their business. And what we've seen in the more recent results that have come out, particularly in the retail space, we've seen generally trading updates are surprising on the upside, where businesses have actually managed to maintain more of their revenue lines than people expected, and also they've been able to manage their costs better than people expected, and so that operational profitability is coming back quite quickly. And that will mean that these businesses will no longer need to bow to the debt lenders, and they will be able to start returning capital to shareholders again in the form of dividends. There's also been quite a lot of cash that is hoarded up on these balance sheets, particularly like in the banks space. In fact, the banks never really had an EBITDA, net debt to EBITDA issue that they had to deal with. It was more to do with the regulator suggesting or guiding that the banks should not pay dividends through this cycle. And I think it was more to do with optics, that they didn't want this image that banks were profiteering while the economy was crumbling. And so banks have, for the most part, not paid any dividends, and it makes up a meaningful part of the return. We've got an oligopolistic. So thank you, Linda. These are tongue twisters for me at this time. Market where we've got 4 big banks that really dominate, and I think those banks remain highly profitable. In fact, their capital ratios have gone far above where they feel comfortable. They prefer their capital ratios a bit lower, and so they will be looking to return dividends to shareholders as soon as the optics are palatable enough for them to start declaring these dividends. Investec did already sort of take the lead in that regard, and they did declare a dividend. It was a smaller dividend, but nevertheless they did declare a dividend, and so they've created a degree of precedent for dividends to come back in the banking space. So yes, I think some companies will be looking to maybe reduce their payout ratios on the margin, and just ride through the uncertainty period with higher levels of cash on the balance sheet. But I think there are many businesses that are ready and more than able to pay their dividends again back to shareholders, and that we'll start seeing coming through in the next 6 months to a year, I think, in the South African space.
So you're saying take the opportunity now and look through the short-term sort of uncertainty. And I think one must remember that the value of a business is, if you look at the dividend discount model, which you all studied, 1 year's worth of dividends doesn't make a huge amount of difference relative to a long string of numbers thereafter. So I suppose one must take advantage of the opportunity and have conviction there. I see Mark has made a comment. I see Adrian Gore, based on excess deaths and evidence from blood donation, indicates that possibly 50% of SA has been infected with COVID already. Would this not suggest that a third wave is likely to be a lot less severe? And I want to just put that as a backdrop, because I think it ties quite nicely to Quibus's question, which is, I think I'm going to direct this to you, Piet. The JSE seems to have run hard since the start of the year. Is this mainly due to the rand hedges? And is there still legs in the market, or should we be cautious of the current high level? Are SA incorporated shares still attractive?
In short, yes, very much so. I was just going to add to what Andrew was saying there. I think the dividend paying potential for South African business is very high at the moment. I think for the most part, most companies' balance sheets are pristine. In fact, many companies have net cash on the balance sheet. They've used the COVID period to get their cost base in order, so that right now on the same revenue, in other words, people spending the same amount of money, the revenue growth, there's not much revenue growth. In the same revenue, you're more profitable because you've managed your cost base a lot better. So I think the ability for SA Inc. to pay dividends going forward, the potential is very high at the moment, which implies that the valuations of SA Inc. Is still quite cheap. The market is up a bit, but remember, it's all very low levels. I think it still has a lot of legs to run. And if you throw on top of that commodity bull market, that creates a massive tailwind for South African businesses. Despite the best efforts of our government, we will still do well in a cyclical sense, not in the structural sense forever, but in the cyclical sense, the business in South Africa will do well. The opportunity, as I said, right now for a value investment in South Africa is still very good. I think there's lots of opportunities in many sectors. I would be cautious, although I would not ignore rand hedges. I think in a commodity cycle, the rand tends to be stronger than otherwise, so the rand hedges per se could get hurt from that. But having said that, the rand hedges generally are quite good businesses, and they also benefit from what's happening in the rest of the world. So I think a portfolio would be unwise to ignore those completely. But I do think the potential for SA Inc. is better at this point in time.
And so David asks specifically, do you have any views on the following stocks: Adapt IT, EOH, Nampak, and City Lodge? SA Incorporated has been completely hammered. Any views on those stocks? Do you hold any of those stocks in your fund?
No, I don't hold any of those stocks. I think those stocks are all possibly with the exception of Adapt IT, both Nampak and City Lodge are highly indebted. And I do think that that is probably the one sort of business you want to avoid at this point in time, is that Africa is a highly indebted business. So there's so many other businesses out there with clean balance sheets. Why would you want to get involved with something like Cerulodge, which is highly leveraged, owns fixed assets where the value is debatable going forward in the medium to long term? So no, and Nampak is just, they've made so many mistakes over the past 10 years that, I'd want to give them another 10 years to get it right before I start looking at them.
Okay, we're going to do another quick poll. I'm going to ask everyone what asset class they think is going to outperform in 2021. So you've got the options of emerging markets, oil, the S&P 500, which I guess is the US equity market, gold, or Bitcoin. So I suppose the S&P 500 is really sort of a continuation of the theme that we've seen over time. And if you're interested in global big tech, that would be the one to go for. See how many are brave enough to vote for Bitcoin. Obviously, there are questions about how one determines the value for Bitcoin. I suppose you could make the same case for buying Tesla in terms of capturing a theme if one sort of says that the actual underlying fundamental value is not the issue here. Okay, so there was a survey done of global fund managers. I want to ask the panel first. I'm going to ask you to each give your views. Let's start with you, Richard. What would you vote? I'm sorry I didn't include property. I couldn't actually add more than 5. Sorry about that.
No worries.
Yeah,
I mean, just looking at that list, I think emerging markets and oil will probably be your 2 asset classes that you'd sort of expect to outperform in 2021, just given where they've come from a valuation point of view, where the current prices are. And I think as COVID-19 comes to an end, we've got this massive fiscal spend coming through from developed markets, which are obviously going to aid emerging markets. We've got sort of loose monetary policies, which are also going to be sort of positive for emerging markets and risk on environment. And as the economy kicks into another gear, just from an infrastructure spend, I do think emerging markets and oil are probably where you'd think you would see a little bit of outperformance versus those other asset classes that you've sort of presented on that list.
Andrew, I want to ask your view next. Which one would you go for in 2021? You can see the results here. They 64% of our participants voted for emerging markets, only 6% for oil. Peter, you might have some interesting views to share there. 17% for the S&P 500. Those are obviously those that believe that tech will continue to outperform. 8% gold and 5% Bitcoin. Those must be the males under 30 that are listening to our webinar today. Andrew, what are your views? What do you think? Which asset class would you go for out of this list?
Yeah, I certainly think that we are in a trend of a weaker dollar, and that's going to be supportive to emerging markets. A lot of the stimulus that has been promised to offset the effects of what COVID has done to economies globally, the actual payment hasn't necessarily all started just yet. I think a lot of the stimulus is still coming, and you typically see these stimulus cycles kind of a year or so after the crash event happens. So I think that's going to be supportive of emerging markets probably as the first bet. And then I would say probably oil and then gold.
Okay, and Piet, your view?
My view is that I'm in the oil camp. I think oil, like most extractive industries over the past 10 years, have cut back on capex. They have not increased their resource base. They have not increased their production capacity. Well, demand is steadily increasing, and if we go into an upcycle over the next year, 2 or 3, if there's infrastructure spend, I think we can see an oil price that goes a lot higher because of a lack of supply. Just with normal demand, I'm not saying demand goes up a lot. In fact, you could probably see marginal declines in demand due to electrification and EVs and all those sort of things. And even in that scenario, the fact that the supply is constrained can still lead to a very high oil price going forward. I think that's a possible outcome. Again, I wouldn't put all my money into that outcome actually happening, but I think that is quite a possible outcome.
And Piet, you have some interesting thoughts on you noted that one of the big trends that we're going to see over the next whatever decade in terms of the investing landscape is ESG, and we have started to see a lot more of that. And how does one sort of participate in that? I know your views are not to buy the obvious stocks.
I think if you believe in ESG as I do, then I think you have to buy copper. There's no doubt that copper is the one investment that gives you the whole ESG trend in a nutshell. Because if you want to build batteries, if you want to build electric vehicles, if you want to build wind turbines to generate wind power, you need copper. And if you want to connect all these things to each other, you need lots of copper. So if the world goes green, which I think it will go and is going, you need to buy copper.
Sorry, and Piet, I think adding onto that copper comment, there's also the health benefits of using copper. Copper has been shown as the one metal where viruses and bacteria survive for the least amount of time. I mean, there are actually some hospitals I think in the Middle East, where they literally have replaced all the stainless steel throughout the entire hospital with copper. They made the basins out of copper and all kinds of, all the structural walls and everything are lined with copper.
Between copper and ivermectin, we'll say we're safe from COVID.
Let's hope so. Let's hope so. So a specific question. This actually speaks to, I'm going to ask this question because it does speak to one of our advantages, I think. As a smaller firm, we're able to invest in some of the sort of small and mid-cap or that are not available to the large funds. Andrew, you and Piet both hold Steinhoff prefs, which speaks very much to that. Andrew, Diedrich wants to know, are you happy that it still shows value at this point? And I suppose, Piet, you can comment on that as well.
I think Andrew's done this on that. He knows more than I do.
Right? Well, Piet and I actually had a conversation over email just this last week about whether or not the value is appropriate, and I mean it's still yielding around 9.3%, and for an instrument that effectively is like a contractual bond in that the dividend payments that they have to pay are cumulative, which means if they miss a payment, they have to repay it in future years. And also the expectation that they want to upstream capital up to the parent in order to restructure the debt, which they are busy doing. You sort of can easily expect that they will continue paying the preference share dividend in order to pay ordinary dividends up to the parent. That's because this preference share is issued at a subsidiary level, not at the parent level, but the debt sits up at the parent level. So they need to upstream all the earnings that really are driven by Pepcore, actually, because they own the majority stake of Pepcore, and they've eliminated most of the debt on that side of the balance sheet. So naturally, they will want to continue upstreaming cash to the parent. And I think that therefore, given on a relative basis where bonds are at, just on a gross return basis, I think that they present reasonably fair value. But if you are a tax-sensitive investor that might be exposed to interest tax if you were to hold the bond at your marginal tax rate, well, then prefs are a screaming buy, particularly the cumulative prefs yielding 9.3 like Steinhoff, because you just can't get that kind of net yield anywhere in the market.
Thanks, Andrew. And unfortunately, sorry, Piet, did you want to come in again on that?
I've got nothing to add. I think that's perfectly right.
Okay, well, we're at time, I'm afraid. There is going to be a survey that'll pop up. Please do give us your feedback. We're planning on doing this if you enjoy the format. Every month, the third Wednesday of every month. But if you hate it, please do let us know as well, or let us know how we can improve on making sort of the most productive use of your time. Thank you, Piet. Thank you, Richard. Thank you, Andrew, for participating this week. And everybody stay safe, stay well, and keep your wits about you as we navigate these interesting times. Bye, everyone.
Thank you, Linda. Bye.